Hi everyone, this is Marla DiCarlo, the CEO of Raincatcher. I am so excited to be able to go through this presentation with you because it's near and dear to my heart as an accountant who's worked with small business owners for most of my career, and I know the importance of financials. So let's get started on Unleash the Power of Your Financials. Growing your small business can be fun and rewarding. It's why we are small business owners. It's why people become entrepreneurs. There's a lot of fun, and there is nothing like building a business that you created, that you poured your blood, sweat, and tears into. But it also is filled with many challenges and obstacles. And I think one of the biggest challenges in small business is predicting cash flow and influencing the future of your company. Without a crystal ball, this can be a daunting task. And so many ask, well, how do I do this? I always say by unleashing the power of your financials, because it's important to understand the numbers behind your business. They tell you a story. They show trends and performance, and they can help you to make proactive decisions for the future instead of reacting to the past. Getting a complete and accurate picture of your financials is very important. The number one reason is you cannot fix what you don't know. So let's go over the 3 most important benefits of managing your financials. First off, it helps by minimizing your tax savings to help increase your profits. Second, managing your cash flow is essential to your business health. And third, building equity is the foundation for your business future. It is important to take into consideration the tax savings of being an owner. I always say, make a plan or plan to fail. Some of you may laugh, but that's very true. Think about that for a few minutes. So let's talk first about important deductions to remember when creating your tax plan. How do you minimize the taxes so that you can increase the profit that you get to keep? One area I like to talk about is your home office, and most business owners have this deduction. The key is that you use the term home office the same way the IRS does. The tax agency says it must be a space devoted to your business and absolutely nothing else. So what that means is deducting the den that houses the family computer and serves as a guest bedroom won't fly with Uncle Sam. So you have to be very careful on the area that you dedicate as your home office, and that the surroundings is in that room is about your business, and that you're not incorporating any part of your personal day-to-day in that room. I know it sounds silly, but it's really important. The deduction, however, isn't limited to a full room, and many people are not aware of this. Your home office can be part of a room. So how do you know how much of the space is deductible? Well, the easiest way is to measure your work area and divide that by the square footage of your home. That percentage is the fraction of your home-related business expenses that you can claim. Some of those expenses include rent, mortgage, insurance for your home or your rent, utilities, and any repairs and maintenance. The second deduction I like to talk about is depreciable assets. When your office supplies are more than just pens and paper, you have another tax cutting opportunity, and many overlook this area. This can include expenses such as equipment, office, furniture acquisitions. It can also include computers and sometimes some major improvements. There's a couple of choices on how you can deduct these costs. One way is you can deduct 100% of the cost in the year of the purchase, or you can deduct a portion of the expense over the useful life of the asset, which is also known as depreciation. If you're not sure about this deduction, you can look it up, or you can also contact your CPA and they'd be happy to run through that with you. The third deduction is mileage. At the end of the year, you basically have two choices. You can total the mileage and add in any tolls and parking to calculate your deduction. And once you have your mileage total, you can multiply this by 54 cents. Or you can measure your business usage against your personal driving and deduct that portion of your auto-related expenses. Remember to include gas, repairs, and insurance. And another great thing is that if your company office is at your house, meaning you have a home office deduction and you work exclusively out of your home, you get more of a break. You can actually deduct the entire business-related mileage from the minute you pull out of the driveway until you return home. If you are leasing, you can include those payments. If you are buying the car, you can factor in the interest on your loan and depreciation on your vehicle. Another deduction that is often overlooked is meals and entertainment and travel. The costs of travel are 100% deductible, such as air, auto, lodging, rental cars, etc. Meals and entertainment are 50% deductible. If you have a ton of travel expenses, a great way to track these expenses is using software such as Expensify. And doing so will allow you to keep track of your receipts and upload them directly into the software, and you can actually make notes and categorize them on your mobile phone, on your laptop, and then you connect that to your software such as QuickBooks, and then you have the receipt, the detail behind that receipt, any notes, and it's saved automatically into your accounting software. Another way that you can keep track of travel expenses and really any expense for your business is if you use QuickBooks. They have an attachment feature on every transaction, and you can actually click on that. It looks like a paper clip, and you can upload a picture of any receipts to that transaction. That really helps when you are working with an accountant or you're having your CPA review your expenses. They can just drill in on that detail and make sure that you've categorized things properly. It also helps if you are unfortunately audited. Makes it much easier because all the detail along with the copy of the receipt is right there with your financial information. Lastly, I would talk about benefits. And this is dependent on your business structure, but most of the time you can deduct 100% of any benefits such as medical, life insurance, education, and retirement plans. C corporations have no limitations. Any other business structures, you should really talk to your accountant CPA about what you can deduct. So one of the most important accounting tasks is managing your cash flow, right? Because cash is king. I mean, I know you've heard that before, and it's true. But trying to run a business without managing cash flow is like paddling a boat without an oar. Even if you succeed, it will be an upstream exercise guaranteed to wear you out. And so the three key elements of your cash flow analysis include accounts receivable, what your customers and clients owe you, accounts payable, what you owe your vendors, and shortfalls. You hope not to have these, but they do happen. You must effectively manage all three if you want to navigate your business to success. Of course, the best direction is to paddle. The best direction to paddle canoe is with the current, right? You'll go faster. You won't wear yourself out. By the same token, your business will be healthier if you manage your cash flow towards profit. And so we're going to go over a few tips to help you row your cash flow boat successfully. Have you ever heard the analogy of garbage in, garbage out? I know you have. Well, it's true. In order to have confidence in your financials, you have to make sure that you have captured all of your revenue and all of your expenses in order to see the full story. One way you do this is reconciling your cash and liabilities. So I put this in red for a reason because one, reviewing your bank balance online does not give you a full and accurate picture of your financials. So, if you're using your bank balance to determine your cash flow, you will run into complications. Your bank balance does not include activity that has not cleared. And so, if you're opening up your bank balance and you're like, great, I've still got $1,000, you may have forgotten that you wrote that marketing subcontractor a $5,000 check. Or better yet, you may forget about upcoming bills and not think about the fact that you may take money out, not think about something that's around the corner. I know with my age, I forget things all the time. So it's important to not only reconcile your cash flow, but also to pay attention to your financials, looking at your accounts receivable, looking at your accounts payable, so you know what you will be collecting and what you need to pay out. Reconciling your cash on a daily basis is so powerful. I can't emphasize this enough, especially if you're having cash flow problems. If you are reconciling all of your accounts on a daily basis, you will have a better handle on your key metrics. Think about the power of daily reconciliation for a minute. If everything is updated every day, that means you have real-time access to all of your key metrics. If you knew your real cash balances daily instead of just opening up your bank balance, would that be valuable to you? As important as it is to know your cash balance, it is equally as important to have an accurate budget. I call it creating a financial roadmap. It is important to predict the future of your company. Big decisions are difficult to make and hard to change. Once you commit to a decision, it is very difficult to change course. One of the most important year-end tasks for most businesses I work with is to work on next year's budget. Often, though, this process is misunderstood. It is not only a financial exercise for the future, but it's also a way for a business to evaluate their prior performance. As the year draws to a close, it's important to take a look at how far you have come and what you have learned along the way. It is important to review your accomplishments. You should celebrate the areas in which you've improved and review how they impacted your life and in your business. Doing this will help you determine your goals and set your path. However, in order to evaluate your performance, you must understand the story behind your financials. Have you heard the expression, numbers don't lie? Well, it's true. They tell you a story. Don't be afraid to pay attention. Knowledge is power. I can't tell you how many owners I've worked with that have what I call blinders on. They're afraid of what's coming up or what's already took place, and they don't want to rehash it. And so they put these blinders on where all they're looking at is what's going on right now. And it's important to evaluate where your business is headed. And it's equally as important to evaluate where your business came from. What decisions would you make differently? What decisions do you want to make in the future? And so in order to know your cash flow, you have to know your numbers. But before you can determine your current financial position and set realistic goals, you must understand your current financial situation. You also need some tools to help you track your progress. Timely and accurate financials are the first step to gaining control. They help you to identify potential pitfalls and help you to make educated and informed decisions. Financials also help you to set goals so that you can project your cash flow, allowing you to be proactive with your finances rather than only reacting to what already took place. So, reading your financials is like reading a novel. Every chapter tells a part of the story. And so it's important not only to review your financials, but you also need to know how to read them. How does your company stack up against competitors? How has your revenue and expenses changed over time? One way to review your financials is to compare current trends to prior periods. So examples of doing this is such as running a report called the Profit and Loss Summary Report and comparing that to your prior year. Most business owners rely on the Profit and Loss Summary Report, but comparing your results to last year can provide quick insight into whether your revenue is growing, as well as how fast expenses are rising. It's also important to look at the profit and loss summary on a month-to-month basis, and sometimes in businesses quarter to quarter. And using the financials and comparing to prior periods will give you information that will help you to be proactive, and you can learn from mistakes you've made or what you've done really well. Another report is the balance sheet and comparing that to the prior year and also prior months, as we've talked about, and sometimes prior quarters. As with your income statement, it's important to compare where certain balances on your balance sheet stand now versus last year. Some of the accounts that you want to look at is your cash account, accounts receivable, inventory, accounts payable, other liabilities such as lines of credit or short-term loans, and to review those changes. It's also important that you reconcile those accounts. So we already talked about the importance behind reconciling your cash activity, but it's equally as important to review and reconcile your accounts receivable, your accounts payable, to do inventory physical counts so that you know your inventory account balances are accurate, and to reconcile your liability accounts to the statements that come in so that you know that when you look at your balance sheet, everything is accurate and real-time information. Another important report is your budget to actual. So here's where I always have a good laugh, and not at the expense of my clients ever, but it's just I already know the answer. So typically when I'm meeting with an owner, I'll ask them, so do you have a budget? And I would say about 90% of the time the answer is yes, I do. And I'm like, great, that's awesome. I'm so glad. And they'll go into the processes they have around creating their budget, and maybe different employees are involved in that process or different departments, which is awesome. That's what you want to hear. But then I'll ask that one question. I'll ask them, so do you use that budget? Where is that budget right now? And most of the time they get sheepish and you see that look on their face and they smile and they say, well, it's in a file. And I say, well, that's what I expected, because that's most business owners. It's really important when you create that budget, not only the process of creating it, but to use it. So you want to either input it or import it into your software, so then you can run these fantastic reports called budget to actual. It's a great report to track your progress by comparing your actuals versus what you budgeted. It helps you to manage your cash month to month, and it helps you to see how your business is performing. Another important report that I feel is often overlooked, especially in small business, is your statement of cash flows. So the profit and loss report enables you to see what you've earned, while the balance sheet report helps you to determine what you have as well as what you owe. However, neither report necessarily provides a clear picture of where your cash is coming from or where it's going to. For that, you should look at the statement of cash flows report. This report allows you to see how much cash you've taken in from sales and how much you've spent on expenses. It allows you to see cash inflows or outflows from borrowing, repayments, or investing activities. In short, this report shows you exactly what caused your bank balance to increase or decrease during a given report period. Finally, another report that I feel is overlooked often is a profit and loss report by customer, job, and service or product. So what I mean by that is most business owners will look at their gross profit margin and their net margin, and they usually know those numbers. But what they overlook is that you're supposed to look at use those numbers to help you gauge how your business is performing. For instance, on your gross profit margin, you should have consistency. What I mean by that is revenue may increase and decrease month to month, but if you're managing your financials in your business the right way, you should see consistency on your gross profit margin. So if you're seeing fluctuations in your gross profit margin of 10% or more, you may have a problem. And one way to be able to determine where that problem is happening, why it's happening, is by running a profit and loss by customer, job, service, or product. Because it's important to know what your revenue generators are and also how profitable they are. And if you're looking at those, a report by profit and loss by customer, and you see that there are customers that are really not very profitable, you may want to make the decision that maybe in the next couple of months you start to phase them out, that you let them know that you're going to have to let them go. And there's many ways you can do that and still maintain customer satisfaction. The other thing is to look at it by product and service offerings. You may have some profitable service offerings or products that you sell, but it only takes a few service offerings or products that are lower in profit margins to drag down that gross profit margin. And if you know what those are, you can make a decision to stop offering them or to phase out that product. So it's really important that you not only look at your reports in a summary way through like the profit and loss statements and balance sheets, but you also drill in on the detail to help you determine where the issues are coming from. So another way to review your financials is looking at your financials horizontal versus vertical variance analysis. What that means is the horizontal variance analysis, also known as the trend analysis, compares your financial statement information over time. Most trend analysis spreadsheets shows both the change in the dollar figure and the year-over-year percentage change. And that's what I'm showing here, where we can see in 2014 wages were $163,000, and in 2015 they were $154,000. And so we had a change from 2015 to 2014 of a negative 5.52%. And if I included the dollar figure, it would have told us that the dollar changed between the 2 years as well. The other way to look at this is through the vertical variance analysis. The vertical variance analysis of the income statement is the practice of expressing every expense as a percentage of net sales, meaning that if we're looking at the vertical for 2014 of wages, which is $163,000, I know that I've spent 32.6% of my income on wages. And then in 2015, where I spent $154,000, I know that I've spent 32.42% of my income on wages. So when you look at the financials in different ways, you'll see different things. For instance, when I originally looked at wages using the horizontal analysis, my heart skipped a little bit. I went, whoa, wait a minute, why is 2015 so much lower? Did I forget somebody, or what happened in 2014? But then when I looked at it as a vertical analysis, it doesn't look so bad, right? Because in 2015 or 2014, I spent 32.6% of my revenue on wages, but in 2015, there really isn't that much of a difference. It was still 32.42%. So I'm not as concerned because I can see here that they're pretty consistent. And so this is a great way to compare month to month and quarter to quarter. And what you can do is you can look for material changes. Basically, you're looking for unexpected trends. You want to note changes and evaluate how they stack up with your expectations. Keep an eye out for large variations in dollar amounts, but more importantly in percentages, both positive and negative. Pay attention to any changes that are greater than 10%. If certain expenses are increasing or revenues are decreasing and you don't know why, that's a sign there may be a problem and you need to investigate. Maybe you need to go back and run one of the profit and loss statements by customer or by services or by product to take a look at what's really going on, or you may need to drill in to that particular expense account and look at the detail and figure out if you've miscategorized something or if there really is a problem. Another way to look at your financials is to compare your company to industry standards, meaning it's really good to know what your competitors are, what their financials look like, and compare yours to peers in your industry so that you can see how you're stacking up. One important number that business owners tend to overlook, and we discussed this earlier, is your gross profit margin. The gross profit margin is your sales minus your cost of goods, and the amount remaining is the profit on the sales after the cost directly related to the sale of the service or item is deducted. That's your gross profit. So out of curiosity, how many of you know your gross profit margin? And I wish I could see your hands, because oftentimes owners shrug their shoulders or say, well, I think I have a general idea. Wrong answer. You really do need to know what your profit margin is, because that is how you stay proactive managing your cash flow instead of looking at that number after it's already happened, reviewing historical numbers and going, oh, well, what do I do? I shouldn't have taken on that job. I lost 20%. And so I'm going to put your knowledge to test, and I'm going to go through an exercise here to help you understand why knowing your gross profit margin is so important. So based upon the revenue stated here on my profit and loss statement, which product should I focus on selling? Home services, home services, home modification, or commercial services? So the answer may be surprising because it's home services. As you can see, even though I earn $250,000 on home services and revenue, I only keep 16% of that revenue due to my higher cost of goods. Where with my home services, I keep 71% of my revenue. With a 71% gross profit margin, I earn more money on home services than I do on home modification services or commercial services. So if I expected my profit margin to be the same, I need to increase my prices on home modification and commercial services, or I need to reduce my cost of goods in order to increase the amount of cash I keep from the revenue I earn. So let's go over this again. If I earn $175,000 in home services in revenue, even though that's lower than the other two categories, my profit ends up being $150,000 because I keep 71% of my revenue. Where on home modifications, where I earn $200,000, I only keep 50% of that, and so my profit is only $100,000. So it's really easy for owners to think they're doing well because they're looking at their revenue numbers and they're not paying attention to the expenses they're spending generating that revenue and what the percentage is that they're spending and what they're keeping. So, what does that tell you? I would rather work smarter and not harder and keep 71% of my sales, or I would rather increase my prices or reduce my cost of goods on my other services so I earn more money. So let's go over this, what we've just reviewed in summary. The gross profit helps the business owner to determine if they are pricing their services correctly and controlling their cost of goods. That includes labor and materials. Increasing sales does not always improve cash flow, as the model we just went through. And setting a gross profit margin target and then monitoring your results each month helps you to manage your cash flow. It allows you to be proactive and not reacting to what already took place, all of which are very important in managing your cash flow and building equity in your company. So, what is the why behind your financials, and why should you be concerned with how much equity you have in your company? Well, equity is more than just a balance sheet term. Your eventual buyer or successor will likely be interested in knowing about the equity that you have built, not about the income that you have achieved within your business at that current time. And as an owner who is considering a future exit, you want to speak in terms of equity and not just in terms of income. Will that successor be purchasing a job from you, or will they be purchasing a well-run enterprise? You see, income can vary according to the personal needs of the owner-operator. However, equity can be expanded and value can be driven into your business once your focus moves to an equity-driven model. So let's talk about that. An owner who builds their business with a primary focus on personal income, for the most part, has a job. An owner who builds their business by making decisions that are likely to increase their equity value has an investment. Your profit or loss helps to build equity in your business. It also affects your taxes, sustainability, and your exit plan. So, how do you use equity to evaluate your business performance? Well, the average debt to equity ratios vary widely between industries and between companies within industries. Even so, it is possible to present some general rule of thumb for evaluating a company's ratios. Your total debt to equity ratio should be 40% or lower, and your long-term debt to equity ratio should be 30% or lower. Potential lenders will compare a company's debt to equities ratio to industry standards. If the company's ratios are substantially different from the industry standards, lenders will need extra assurance that the difference does not represent increased risk, especially debt service risk, which is obviously a negative thing in a lender's eyes. They obviously want to minimize their risk. Potential investors will also consider carefully the sources of existing debt as well, along with the company's ability to be able to repay their debt. So, as you can see, it is important to understand not only your numbers, but also how your numbers compare year over year and to your competitors, and whether you are building equity within your company. I hope that this has been helpful, and I hope that what I've done has helped you to look at the story of your financials, how you read your financials differently than before you took this course. It really is important to not be afraid of the numbers and remove the blinders. Whatever you do, don't put on the blinders. It's okay if you've made mistakes in the past. What's important is to use those mistakes to help you in the future, help you to make better decisions. Accounting is known as the language of business, and I hope you can see why. Understanding your financials unleashes the power to make better decisions and drive your business towards success.